My name is Frank Fantozzi, President of Planned Financial Services, and I want to welcome everyone to our 14th Annual Cleveland Economics Summit. So it's been 3 years since we've had a chance to have everyone together, and it feels great. Because I think, Dr. Jeffrey Roach is the Vice President and Chief Economist and investor of investment solutions over at LPL Financial. And he's really going to talk about what he sees happening today. He's going to talk about his spin on things and where we see the economy going, and really separate what I think is the nervousness that you hear in the news, and really kind of get into something that are more substantial facts and what we can see as more predicated of what's going to happen going in the future. So he serves as a voting member of the LPL Research and Strategic and Tactical Allocation Team. Prior to joining LPL, he was a senior economist at Visa. He began his career as a senior economist at Bank of America corporate trading floor, where his group was responsible for the internal economic research that was closely guarded and periodically sent to the Federal Open Market Committee officials. To this day, he continues to maintain frequent contact with the Federal Reserve economists, Wall Street analysts, and other leading economists around the world. He's also presented economic research to Italy's... What's that? Did someone falsely pull the alarm? You know, it's always something. We're going to get started, everyone. I pretty much finished Jeff's bio, so I'm just going to call Jeff up. I mean, literally, I was on the last line and couldn't get to the period, so I just want to welcome Dr. Jeffrey Roach from LPL.
Well, thanks, Frank. Appreciate it. Yeah, thank you. Thank you for that great introduction. You cued the sound, even that. I thought that was my music to get me ready to get on stage. So, yeah, it's funny. I guess you people are refreshed. And anyway, good to be here in Cleveland. My wife is from Toledo, and so coming into Cleveland, I called my mother-in-law on the way from the airport to downtown here and told her that. Felt like I was, close to home. What we love about Toledo, we're pretty artsy in our family. My 10-year-old daughter plays cello, and my 14-year-old son plays piano. My wife and I are in choirs. I actually just played in a wedding last weekend. So when we're not talking about economics, we're jamming out. But in Toledo, besides Tony Pacco's, which is also very high art, outside of Tony Pacco's, you have a fantastic museum in Toledo. And of course, I hear that there's a wonderful museum here in Cleveland as well. There's a beautiful symphony, art museum, etc. And maybe Toledo learned from its big brother here in Cleveland. So apparently, there's quite a beautiful art scene here. Let me get my laser pointer, because an economist without a laser pointer, I don't know what that's like. Okay, so I got that. Okay, good. And I need to go actually to my presentation. Look at that. All right. So the laser works. Not getting my... There's a little bit of a lag here. All right, hey, that's okay. We'll roll with it. When I told my 10-year-old, when life gives you lemons, you make lemonade, right? I told her that 2 days ago because we have a pool and we're from Charlotte, and it's still warm enough, so when I'm not in my work office, I work at home, and we have a pool, and so I do a number of laps to kind of, get the blood flowing again. And I was telling my daughter, I had an accident with my goggles in the pool 2 days ago, so, my eyes all red. I said, Margaret Jane, of course, in the South, you have to do the double name. I apologize already for that. I said, Margaret Jane, there's going to be some way, I don't know what, I haven't figured it out yet, but it's only day 2, so I'll figure out there's some way to make lemonade out of this eye problem. But what we're going to do tonight, there are a ton of things to talk about. I started my career just before 9/11. So it seems like a lot of my professional career has been marked with numbers of shocks to the system. My mom always asked me, "How can you do this, Jeff?" And I thrive on it. I love it. But so, given the fact that there's always interesting shocks on the economy, some are larger than others, I wanted to give to you my top 3 ideas to kind of introduce, talk through, give you highlights, and then I'm going to open up for Q&A. Even though we did have a slight intermission, I hope, where's Frank? There's Frank. Hopefully we still have some Q&A time.
Yeah, we do.
So I'll talk faster than I normally do so we can have Q&A. I love to hear what people are thinking about. Anything goes, religion, politics, economics. When you talk about someone's money, Frank knows about this, right? When you sit down with someone and talking about money, that is extremely personal and emotional, right? And so economics can be like that. So I'd love to have some Q&A. And if I don't talk about something that you'd like to talk about, please, that's when Q&A comes up. In my mind, the top 3 in this era is kind of the inflation story, the recession story, and then the central banking concept. What is the Fed going to do to us? What is it going to break? So these are kind of the 3 hot topics of a list of maybe 75 hot topics right now. So top 3. Let's just get through that, and then we can freewheel and you just ask questions. What I want to show you with this here is inflation is extremely nuanced right now. So I went to Harris Teeter. It's a southern, anybody from the South? So sorry, I keep on throwing out like these southernisms, and I very much apologize. I was born in New York and I lived in California, so I don't know. I have an identity crisis, I think, sometimes of knowing where I am. But I married a Midwesterner. Highly nuanced. Went to Harris Teeter, bought my ground pork, and I don't have, I have my, I'm very persnickety about my chorizo, so I get my ground pork, put in my seasoning myself. I don't want to buy anybody else's chorizo. $5.99 a pound. It's been that for 3 years. Harris Teeter organic ground pork. Thinking, okay, well that's very different than, when I go to the store and for my kid's birthday, they always get to pick a cereal full of high fructose corn syrup. And of course, it's Fruit Loops, things like that. Cereal's just outlandish in the last 2 years. So what this graph is just showing you that when you think about inflation right now, what's happening is in the goods prices, we've come way off the peak of inflation. That's the blue dotted line. So think about furniture, think about appliances, think about used cars. All those durable goods prices are clearly past peak inflation. The problem, though, is you still have these nagging components, particularly in services, that have not seemed to ease at all. They seem to continue to accelerate. That's one of the major factors that our own Cleveland Fed president has been highlighting in recent speeches, that hey, we're not convinced that inflation is rolling over yet, hence the Fed needs to respond by hiking interest rates. Our view is, and this is what I've been trying to argue, is when you think about inflation, it depends on what you're talking about. And in many ways, if you're part of the 65% of the economy that owns a home, rent prices mean nothing for you, and you're not experiencing any of that orange line. You don't have rent. Now think about this. If your income is over $100,000 a year, 86% of that cohort are homeowners. Again, meaning rent is irrelevant. You're not paying that. So inflation is highly nuanced. Depends, my inflation's not your inflation, which is not your neighbor's inflation. Depends on what your basket of goods, what you're buying. if you will, and wanted to highlight the fact that we have turned over. That's my view. The Fed is not maybe convinced at that view, but if you look at kind of the components, you say, okay, this is compelling. If you actually say, hey, look, and I apologize if you feel like you're in Econ 101 here, there's a lot of different ways to actually measure inflation. So when you think about these conversations with Fed officials and thinking about why the market is so preoccupied with the inflation story right now, is not one measure is a little bit different than another metric. We're actually going to get the Fed's preferred metric next Friday. So next Friday morning, 8:30 in the morning Eastern time, we're going to get a more comprehensive view on what August was like. So this is a little bit lagged, right? And so there's these changes month on month. And what the market seems to be preoccupied about right now is that year-over-year growth rate. It's still way above the 2% long-run target, but it's easing, and that easing is what I think eventually the market will take some comfort in. So I already mentioned this to you in the sense that shelter costs are irrelevant for those that are homeowners. And so in essence, and my bottom line is what I'm doing throughout my talk here is I'm going to throw you a graph. I got to throw graphs out there, but I'll give you kind of a summary key point, and then we'll move on to the second hot topic. So kind of that summary key point is what counts right now in inflation, even though it's still elevated, is this duration and direction. Are we moving in the right direction? Once the market gets convinced that we're over the peak, I think that's where you can kind of see some lower volatility and some improvement. So it's this duration and a direction that's important for the inflation story right now. So, all right, next hot topic is recession. All right, everybody stood. We need another fire drill. Okay, no, okay, we don't need one. All right, next hot topic is recession. A lot of confusion about recession. A recession is a dramatic decline in the economy that's broad-based and that lasts for a number of months. So it has to be a significant decline. It has to be broad-based, not just in one sector like housing, and it has to last for a few months. So when you look at the last two quarters, Q1 and Q2 of this year, it was negative, but it wasn't broad-based, and I'll show you. This is growth rates in the economy. Q2 of last year, 3, 4, here's Q1 this year, Q2 this year, and it's broken up by components of the economy. So yes, we had 2 negative quarters of GDP. Wasn't broad-based because look at all the amount of consumer spending that was very strongly positive. And we could say, look, it's okay that we've had 2 consecutive quarters and not define it as a recession because it wasn't a significant broad-based component. And that's actually happened before. Most of the time when we do have consecutive quarters of growth, we end up finding out, yes, this is indeed recession. We have to go back to 1947 for the last time that we had 2 consecutive quarters and we weren't in recession. So if you know anything about 1947, I believe that is when the Queen married Prince Philip back in 1947. But more importantly, the U.S. was coming out of a world war. There was a complete reversal and kind of retooling of our labor, right? Who was working where and how, what we were producing as an economy, right? We were moving from wartime to peacetime. And in many ways, I would say that that's really a great analogy for what the post-COVID world looked like, right? So we went from, okay, sorry, nobody's doing anything, and then kind of this reopening. We were in San Francisco. I was in Silicon Valley working for Visa during COVID, and I had maybe my wife's Midwestern values when Governor Newsom said, hey, you can't go anywhere, and we're thinking, I can go anywhere I want. I'm an American. So we enjoyed all over California with no traffic. It was fantastic. We could go from San Francisco to Monterey Bay, Pebble Beach in about an hour and a half. That's like a 3.5-hour drive. We could go to Yosemite. We could do Yosemite in a day trip. That's amazing. So it was a great time to be in California. No one was on the roads. So the point is that as we're coming out of this COVID world, it's kind of coming out of what we might think about wartime to peacetime. I think that's why it's really helpful to think about where we are as an economy, and this retooling is important to think about and not be confused or misled with these mixed signals of 2 consecutive quarters of negative GDP. That is not a recession. All right. So what keeps me up at night? So the challenge is we still have quite a number of people that have not re-entered the labor force since the pandemic apparently has ended. So we still got 5 million people that have not re-entered. A lot of those actually are 45 and up, interestingly enough. And I think the narrative, kind of the storyline that's kind of behind it is that, by the way, an economist is 1/3 mathematician, 1/3 philosopher, 1/3 storyteller, right? We're looking at the numbers. What's the narrative? What explains these numbers? So I think the narrative behind that is, you think about your 45 to 60-year-old, they've accumulated enough wealth. They've said, okay, I might be told, all right, hybrid, no hybrid. Come to the office 5 days. Oh, don't come to the office at all. Oh, no, pick Tuesday, Thursday. No, Monday, Wednesday. So people that are saying, hey, I got enough wealth, I'm going to say, I'm out. I'm going to wait until there's maybe some more clarity. But there's that component of the wealth effect for that cohort that allows them to say, yeah, I'm going to sit out for a while. The challenge, though, is what this graph is showing you. This graph is nothing more than, since 2012, just the trajectory of people that are employed in this country. So yes, we're back to pre-pandemic levels of jobs, but remember, a lot of people were born in the last 2.5 years, right? A lot of people came from college to the workforce. There's this, Gen Z is now, getting a greater percentage of the total population. By the way, millennials are reaching peak home buying age. Interesting to think about what those demographics are doing for the economy right now. But we're clearly way off trend. And that's a challenge for how do you say, okay, let's get more people working. And at this point, that's a challenge. So here's my bottom line for the second hot topic. Everybody with me still? So I taught economics during my PhD work, and I got very used to people, just talking to people's eyelids. When you're teaching, Clemson football players, it was just I didn't even care if people were awake anymore. I just kept on talking. So you're doing a lot better than Clemson football players. Just want to let you know. Second hot topic of 3, I think we're still on track for a good Q&A. Second hot topic of 3 is recession. 2 consecutive quarters don't imply that, but we do need to watch some of these very high frequency indicators. I actually track credit card spending. Of course, look at some of the high frequency data in housing, as well as some of those consumer-related metrics, labor market-related metrics. Those kind of things are really important as we go into 2023, right? So it's true, to throw a little bit of water on the fire here, recession risks are rising for 2023 because of the aggressive nature of the Fed's hiking. We'll talk about that in just a second. So consumer spending indicators, weekly claims, some of those will help us with recession. All right, third hot topic. So when I was on the trading floor at Bank of America, we would get a call periodically, and my boss, Ian Banwell, who's the chief investment officer at the time, would say, hey guys, Greenspan's on the phone. Can someone pick up? And we would give him a lot of Bank of America data on deposits, really interesting data. This is kind of the beginnings of that big data world and high frequency business data that really complement some of the backward looking government data. So yeah, I guess I should warn you, if I turn out to be particularly clear, you've probably misunderstood what I've said. That you could probably cross off Alan Greenspan's name and just say, said every economist out there, right? Hopefully tonight will be clear. Key points on the Fed. So as you know, in our country, we have a very important democratic emphasis on not just legislation, but even in central banking. So as you know, or well, maybe you don't know, there's 12 regional banks in the Federal Reserve System. And there's a rotating basis calendar where each of those presidents of the regional banks are on the Federal Open Market Committee, which is the committee that sets interest rates. So what happened way back in the day, really goes back to Alexander Hamilton, we said, okay, and just like we have this balance between senators, two from each state, and those in the House based on population, in many ways, central banking was just like that. You didn't want people inside the Beltway making all the decisions for central banking, because you can think about, well, Minnesota's very different than, Dallas or Cleveland or Atlanta, all these, Kansas City, right? They all have very different economies. Anyway, all that to say is the Federal Open Market Committee is made up of members of the Board of Governors. Those sit for a while on the committee, but then this rotating component within that committee of the presidents of the regional banks. And at this point, they're aggressively front-loading. You probably are getting sick of that phrase, front-loading interest rate hikes in order to address the inflation problem. One of the challenges is, just like inflation, it depends on what you're looking at, right? My inflation, your inflation, our neighbor's inflation. Same thing in terms of where we are in interest rates and where this is going. I think the challenge is you say, okay, well, some members are very aggressive. Hey, we need to hike to above 5%. Very hawkish folks. Then those that are more dovish, Mary Daly, who's president of the San Francisco Fed, more dovish, saying, okay, we don't need to hit 5%. Well, yesterday, the Fed met, and they periodically release what they call the Summary of Economic Projections. And that gives us what we can see individually, what all those presidents of the districts expect on things like growth, unemployment, and interest rates. So what we found out yesterday, and this actually, I blogged about this yesterday right after the 2 o'clock talk, and we basically said, hey, the Fed's getting more pessimistic, but probably more realistic, in that the Fed has downgraded their growth expectations for the next couple of years, upgraded, if you could say that, unemployment rate's going to hit closer to 4.4% the next couple of years, higher unemployment, lower growth, and you actually compare that with the Congressional Budget Office's forecasts, and they're actually getting more aligned, which is quite fascinating. I think in some ways it's helpful to think that I think some of the market volatility is probably going to get a little bit softer, given the fact that the Fed is becoming more realistic. They're not completely clueless saying, okay, no, we're going to hit these targets. Everybody else is saying, I don't know what you're smoking here. We're going to do, this kind of growth rate. Fed is moving into perhaps even a more broad consensus view. So we'll probably hit 4% by the end of this year. Another some hikes in March, perhaps in May of next year. I don't think we're going to hit 5%. In fact, if you even look at some of the more hawkish folks like the president of the Cleveland Fed, they're at 4.75 is kind of that peak rate, middle of next year. So what's challenging is kind of piggybacking on what Frank said, negative news sells. Same thing goes with the talking heads in the markets, right? You have Larry Summers, who, by the way, is a great guy. I love him to death. I did a postdoc at Harvard and interacted with Larry. So, people talking about, it's going to be 5.5. We need to raise 100 basis points, and we need to be more aggressive. Well, those are talking heads. Those are people getting headlines. That's how you need to respond to that. Capital markets do matter. This actually started with Greenspan. At the tail end of his career, kind of started talking a little more about the fact that, hey, it's not just money supply, inflation, it's broader. Bernanke was a little more open on that. Of course, Yellen, and then Chair Powell. It's important to realize capital markets matter, and the dual mandate still matters. What I thought was interesting is, what's unique, and what I think we're doing still good on time, because this is a hot topic, 3 of 3. The central bank in this country is a little bit different than any other central bank. So most central banks in the world, European Central Bank, Bank of England, et cetera, have one mandate, and that's price stability. You'll hear those folks talk about price stability all the time. We have a dual mandate by Congress, 1913. Congress actually instituted the mandate. In fact, Frank and I were talking about this the other day, for the Fed to focus on price stability and full employment, which is another way of saying a growth mandate. There's an inflation mandate and a growth mandate. And that's a challenging balancing act. I think it's quite beautiful to think about. It's another example of just kind of the beauty in this country. I already told you about the democratic feel of the Fed. No other central bank has that, by the way. The structure of a representative central bank, if you will. But the dual mandate means that they do care about growth as well as inflation. At this point, it's heavy inflation, but they have that dual mandate. One of the things I'm going to leave you with is when you think about the 90s, it's a great example when inflation wasn't very high, but the speed or the rate of change of inflation was pretty aggressive, kind of popped up 150 basis points from a 2.5 to 3.5 to almost 4%. Again, still very low, but the change was really quickly. It just kind of that peak. The Fed responded by hiking rates in the mid-90s. Well, the labor market started slowing. And what was fascinating is you saw the Fed respond by holding the line for a while and eventually actually cutting rates a little bit. This was all the mid-90s where there was no recession. And so what I like to say to folks, and I think the market can feel a little comforted in that sense, is you have seen historically periods where the Fed hikes, watches, perhaps even responds in another way as the economy weakens, and the economy never enters a recession. Think about 94, 95, 96. Those years were fairly stable. So it's important, my takeaway for this one was, don't get too focused on these various news bits of the talking heads saying, hey, we need another, 1% move. Financial conditions matter. We didn't talk about this, but the Fed does look at supply chains, for example, because they need to say, all right, part of the inflationary environment right now is because people just can't get parts. You want a compressor. We were doing a renovation in 2021, and you look for parts. You say, okay, well, we have no idea. It could be a year. It could be a year and a half. We don't know when we might get these parts, and that's still happening still today. The challenge is the Fed has no control over supply shocks, just aggregate demand. So the supply story, as that improves over time, and we're already seeing it easing, that should be another variable that the Federal Reserve will say, look, we know that inflation is slowing down. So there you go. Of the 50, we went fast because we were interrupted by our outside break. But I'd love to take some questions. Love to hear if you have any further requests for clarification on what I mentioned earlier, or if you want to talk about really anything under the sun. I try to tell my kids, economics is fun. You can talk about anything you want to. And goes back to economics. I mean, eventually. So, any questions? Yes, sir.
Yes, where did that 2% that the Fed used figure come from?
Yeah, that is a.
The reason I ask is that there's some economists that don't agree with that, and they feel that it may be more important in the Fed overreacting and becoming a recession.
Yeah, that's a great point. I'm going to repeat the question for the videographer. All my microphones here. So the question is, what's so special about the 2%? Sorry, I'm paraphrasing. What's so special about 2% target? Why does it matter? Can it change, right? Is it set in stone? So the answer is it's not in the charter, right? So the Fed doesn't have that in its charter. There's nothing required about a 2%, right? It's the dual mandate of price stability. That's the official statement from Congress in the formation of this 1913 version of central banking we have, and full employment, that dual mandate. The 2% comes from really kind of this gentleman's agreement across the globe. We have a very globalized system, and so we, in essence, when we think about the central bankers here, we've basically had an agreement to say we need to coordinate with what's happening in other parts of the world, which is one reason why you might say, okay, that explains why the Bank of Japan, the Bank of England and the European Central Bank are also front-loading rates. Eventually, Bank of Japan is going to have to do something because their currency is, going to pot, and they actually acted for the first time since 1998 overnight for their yen intervention. But the point is, the 2% is really based on what other economies can feel, G10 economies, can feel as stable. It's a lot of conversations actually are happening right now about saying, okay, well, maybe the Fed can be a little more comfortable when we finally hit, say, 3.5%, right? That's a lot better than 8.5%, and we would all agree with that. But the point is, you want something that's fairly stable, even relative to the rest of the world, to hit that 2% rate.
So wasn't that part of the conversation today where they said the 3.5 maybe is more of a practical target?
So what the Fed's done in more recent years, and you think about the change in culture, like any corporation, right? A CEO develops his or her own culture. Well, from a Greenspan to a Bernanke to a Yellen to a Powell. Powell has talked about 2% average over the long haul, meaning that it could be a little bit below 2%, could be a little bit above 2%, but on average, kind of hovering around that 2% for international reasons. Yes, in the near term, I think the markets, I think everybody would be really happy if you hit 3.5. You think about what's going to happen on Friday, this next Friday, where you'll get PCE deflator, it's called, but it's based on personal spending and income. You'll get that more comprehensive inflation metric, and that's gonna be coming down pretty quickly, and I think by the end of the year, it'll be like 4.5% on the core. Maybe close to 6% on headline. So yes, there's nothing special about 2%. There's nothing magical about that. It's that international global agreement. Yes, sir.
How do you believe that these rates will affect housing prices and the housing market, as well as CPI or non-homeowners?
Yeah, exactly. So when the Fed hikes rates and tightens financial conditions, it takes time to show up in some sectors, and it takes maybe 2 seconds to show up in other sectors, right? Credit markets, et cetera. Housing market is a lot closer to real-time credit markets. Think about where mortgage rates are, right? Over 6.5%. We have not seen the full effects of the hikes in the labor market. Businesses say, hey, we might change our capital expenditures or maybe our plans for labor. Eventually you think about tighter financial conditions from the business side, and that eventually shows up with some impacts on labor. Housing is very quick to react. and we're seeing that permits and starts are lowest since, pre-pandemic levels. I think one of the challenges, I hinted at this when I was talking about Gen Z and millennials, there's still such a short supply of homes, given the fact that millennials now are hitting peak median buying age of first-time buyers, where you'll see there's going to be some rebalancing in home prices. You're already seeing that across the board, but it's not a 2008 kind of scenario or a 2010 scenario. You think about the great financial crisis. If you could fog a mirror, you could get a mortgage. That's not happened in the last 3 years or 4 years, right? So there's a little bit a different story, the narrative of what's happening in housing relative to the previous crisis. So yeah, we still have downside to go in housing, bottom line, but this is very different than, say, the popping of a bubble, say, in 2010 and 11. Do we have maybe one more?
A couple more questions.
A couple more? Okay. Yes, sir.
How do you see all this correlating then with the market equity?
Yeah, so I've hinted kind of throughout the talk is I think as the market gets comfortable understanding that we're past peak, you're going to see lower volatility. You'll see, I think equities are up from here, the end of the year. Typically, midterm election years, you hinted at it, Frank, that is typically, it's like 95% of the time, you have a pretty good handle that things will go up. I think what's happening, again, as markets get convinced that inflation is easing, that's going to create some upside for equities and just general lower volatility. You think about this. So I loved living in Silicon Valley. One of the things that I appreciated was finding quick, high-frequency data. There's a firm that tracks rents, and across this country, rents fell month on month in August. We're talking Zoom towns, but also even like Chicago, some of these major metropolitan areas, as well as areas like in Tennessee and across the Southeast, rents fell a good amount across this country. Not everywhere, of course, but the fact that you're starting to see rents fall like that, that's clearly a good sign that even the services portion of inflation is starting to ease. Yeah. Yes, sir.
We're kind of dealing with the fallout of some of the government spending that happened 2 years ago. And we're still continuing with government spending. So why aren't you going to see that come to fruition in another year and a half? Why don't you think that inflation is going to continue?
Yeah. So the component, you think about inflation being demand-driven and supply-driven. There's both components, right? So you have whether it's public spending or private spending. A lot of times we talk about public spending perhaps crowding out private spending, and that's kind of that negative feedback loop on that side. But then on the supply side, this is why I think it's so important to think about the supply chain component. So I track. This is a great, if you have some insomnia, go to the New York Fed's website, and they have a global supply chain index, and they track not just, what hit the press with, ports, but intermodal traffic, with rail, trucking, all that kind of stuff. You're starting to see across the globe the supply chain story improve. And I think even if you have some crowding out from government spending, you have this supply component that has a real big downward pressure on inflation, and that's going to come. In fact, I'm not in this camp at all, but there's a number of folks that are starting to argue about major deflation, coming ahead. I don't know if Frank, you've seen some of that, Jeffrey Gunlock and some of those guys, talk about deflation. I don't think that's going to be the case. But I totally buy into some of the logic and why they get to that. But I think that's part of the reason. It's the supply side that's going to make a pretty big impact on pulling down the current rate of inflation.
If the supply chain catches up to the demand in the market, is that going to bring prices down?
Exactly. So when this gentleman was asking about housing, I was talking about certain areas of the economy. It takes a while for tighter financial conditions to slow aggregate demand. But you're exactly right. As that filters through to the rest of the economy and slowing the aggregate demand side of the things, which is what the Fed can impact. They can't do anything about supply chains. Thankfully, they're improving for other reasons. When you have both components pushing in the same direction, meaning the inflation easing. Now, granted, we're moving in the right direction this year, but yeah, this is going to be a end of 2023, maybe even a 2024 event when we get back to say like a 2% rate.
Are we still spending a lot of that $2.5 trillion that's driving consumer spending?
I think savings is still really, really elevated. So we track. This is something I learned from Bank of America. You can track saving consumer balances in savings accounts. That's still very elevated, and so that is definitely kind of driving what really the resiliency that we're seeing the last several months in consumer spending because of that. Yeah. I think we better cut it. People are like, get off the stage.
Another fire alarm.
Fantastic. Thank you very much. Thank you, Frank. Yeah. Exactly.